We got some big economic data that came out this morning that shows the economy is not nearly as strong as what investors previously thought it was. You also got some data this morning that was pretty inflationary and overall kind of set a bad tone heading into tomorrow's PCE report. Keep in mind, you do have Microsoft and Google reporting earnings here in just a few moments, and I believe they're going to be good earnings, but those stocks, they're probably going to fall. Why is that? They're trading near all-time highs. Expectations are high. They're probably not going to be able to wow investors. And in this market, if you're trading at all-time highs and you cannot literally wow investors, you're probably going to fall after earnings. That's essentially what happened with Netflix, and that's what just happened last night with Meta as well. So we're going to get into all of that here in this video. Stay tuned. I do want to share with you first things first what Tom Lee just said on Cnbc today about markets.
Right now, reaction and maybe what to do. Tom Lee and Joe. Tom, I'll start with you. Honestly, I don't think enough attention to this capital gains proposal we got last night. I think that might be sprinkled in here, but anyway, GDP's getting all the attention. Steve laid it out nicely. What is your take?
I agree with Steve's point. You know, the GDP number did catch people off guard, the core price index being basically a hot number, 2.9 year over year. But it is going to come down to the revisions, which everyone expects. I think there's also now a disconnect between the CPI numbers we're seeing and like what we hear from companies or even consumer surveys. I mean, for instance, in just this first quarter earnings season, the mentions of inflation as a problem is now at the lowest level since the first quarter of 2021. So it makes me wonder how is inflation accelerating when fewer companies are even mentioning it as a problem in the first quarter? I think that there are catalysts, in the next couple of weeks. I mean, the first one, of course, is tomorrow to see really what March inflation looks like. But I think the earnings backdrop has actually been very supportive. 80% of companies are beating. So as painful as the last couple of days have been, and really the last couple of weeks, I actually think it's the risk reward's positive here.
So the firm landing is here, in my opinion. We did hear from Whirlpool. We did hear from Harley Davidson that they are having difficulty passing through rising input costs to the consumer. And that's not a bad thing. In fact, if you look at the price action today, right now, where we are in the market, we have recovered everything that we lost after the GDP print and after the inflation figures were released. So we've recovered it all. This is really where we sit in the marketplace right now off of Meta and the spending that's attributed to Meta. I think that the rest of the world is experiencing a disinflationary trend that ultimately is going to get exported here to the United States. Brian, you look at Europe, you're talking about inflation readings that are in the twos, whether it's France or Germany. Italy's at 1.2, Asia is in outright deflation. That's coming here, and I just don't think that's a bad thing. And the premise for buying equities in 2024 never was about the Fed has to cut rates, because if it was, at the beginning of the year when there was 7 rate cuts priced in, now we're pricing in 1 rate cut, maybe in December, well, the equity market would be lower from the starting point. We're actually higher.
And Joe and John, jump in on this. Can we just remember the Super Bowl with the Falcons and the Patriots, and the Falcons are up like 100-0 at halftime,
28-3,
whatever, and then Brady comes back and wins. Can we all just acknowledge that the stock market is up this week? Even with today, we're still higher for the week. We're only like 1% or 2% off all-time highs. Market has one big down day.
Profit margins are strong. Everyone wants to focus on the economic recession that never happened. The real recession that happened that matters most is the earnings recession. And we've come out of the earnings recession in the second half of 2023 for the S&P and the NASDAQ. We're waiting on the Russell, and that's a catalyst.
Yeah, Tom, though, we've got a couple big names tonight, and we'll get Dan's take on that in just a second, Dan Ives. But, I mean, what if Microsoft and Alphabet soil the sheets? I think is that the family-friendly term with the numbers tonight? I mean, then what? Because Meta kind of did.
Yeah, I mean, Meta was up 40% into the earnings report, so I think expectations were high. I think there has been sort of a reset, so I think there's if it's a beat, we could see stocks rewarded. And overall, it has been a good earnings season. 80% of companies are beating, and if you really exclude energy, you're really pushing up against double-digit earnings growth year over year. So it's exactly what Joe was saying. It's been a pretty nice earnings recovery. And I think as you get into the second half of this year, healthcare no longer has negative year-over-year comp. So, you could be back into mid-teens earnings growth. So I think the earnings backdrop's really supportive, and there's still $6 trillion of cash on the sidelines.
With that clip played, I think me and Tom Lee share similar opinions on many different things. Like, you would rather be long in this market, earnings are going to come in better than expected across the board, but the expectation is just too high. So I do think that sets you up for disappointment in certain stocks that are trading at very high levels and very high valuations. Now, I think the biggest thing that could dictate what happens to the markets from this point on is how inflation goes and the economy, because this morning we got a little bit of a warning on the economy. This morning, we had the GDP growth rate quarter over quarter advanced data for Q1. There's going to be 2 more of these quarter over quarter readings that will come out. But what happens lately is the first reading is really high and then the other ones come down. So if this was the high one and the next 2 are even lower, you're going to be in for a big, big problem. So the estimate was about 2.5% quarter over quarter GDP growth. You came in at 1.6%. That was almost 1% lower than what Wall Street was expecting. The economy is not nearly as strong as we thought. But what's weird is, take a look at this. GDP price index quarter over quarter came in at 3.1%. The estimate was 3%. Last quarter was 1.7%. So you're literally almost a double up from last quarter. That's not great. Now, core PCE prices quarter over quarter came in at 3.7%. The estimate was 3.4%, so that was higher than expected there. Last quarter was 2%, so almost a double up there as well. And then PCE prices quarter over quarter came in at 3.4%. The estimate was 2.9%. So basically across the board, as far as your inflationary data, your PCE for quarter over quarter, it came in a lot higher than expected. And I don't want to say it. Do you want to say it? Can you say stagflation? Can you say stagflation? That's, I guess, a no. But stagflation is not good. And that's like the stock market's worst enemy is high inflation, stagnating growth. If you're going to have high inflation, you better have some high growth to go alongside it. Because during a stagflationary environment, where there's stagnant growth, maybe not, recessionary, but stagnant growth and high inflation, it's not like it makes sense for the Fed to necessarily cut rates because the economy is still doing okay when inflation is strong. It really puts the Fed in a bit of a tricky situation. And that could be the direction we're heading in. We do need more data, in which we'll get that data coming out tomorrow morning. And tomorrow morning, I would expect to see a huge either fall or rally in markets. You are going to get core PCE price index month over month expected to come in the same as last month. So 0.3% was last month, and that's what you're expecting again. I actually think the expectation is pretty high. Maybe you do come in light. And again, when you look at the quarter over quarter PCE data that we got today, that is including January, February, and March. These PCE data numbers that we're going to get are just for the month of March. Maybe it's possible January and February were really high, and then March wasn't as high. That is a possibility. So it is a possibility that even though you had bad PCE data today, you could actually get PCE coming in below expectations tomorrow at about 0.2%. I wouldn't say that's my base case, but I do think there's a pretty strong chance, like a 30-ish% chance that you come in around 0.2% coming tomorrow for core PCE. Now, personal income month over month is expected around 0.5%. Half of 1%. Yesterday, you were at last month, you were at 0.3%. So expecting personal income to rise, that's not, again, necessarily good for that stagflationary argument. If companies' input costs are rising, they tend to pass on cost to customers. And then personal spending is expected to fall as well from 0.8% last month to 0.6%. Now, based on the PCE data that we got, the quarter-over-quarter data, 10-year Treasury yields went up 5 basis points today, even though it showed the economy is not as strong as people thought. It's still not weak enough, though, to justify we're going into recession. The Fed should start cutting rates sooner. Now, that's not good. You're at 4.70%, a new high for 2024, and it looks like you could be knocking on the doorstep of 5% 10-year Treasury yields in the not-so-distant future. At that point, I think markets start to break. Or at the bare minimum, you start to get more concentration into big tech, assuming that Google and Microsoft earnings are good, in which, again, I think those stocks are going to fall after earnings because I think earnings expectations are too high. Although they are down today, so that does lower expectations. Maybe the falls are not as extreme, but we'll have to wait and see. I believe they report earnings like 20 minutes after the bell or 30 minutes after the bell, something along those lines. And they will obviously have a role to play in how the markets trade coming tomorrow. Now, here at the time of recording this video, you are back above your 100-day moving average. If indeed things are okay with tomorrow's data, if big tech earnings do not disappoint, then you're likely heading back to your 20-day moving average, which is around 433 on the NASDAQ. That would represent upside from here of about 2%. Okay. If things are bad, if tomorrow's data is bad, if the earnings are bad, then I do think you do fall down to that 200-day moving average. And that would put the NASDAQ down to about 396. That's not even a bad place to be. I mean, considering you'd still be up from your October-November lows, about 16.5%. So it's not like that would be a terrible level to be at. It's not like the markets would just be falling apart at that point. But I think we really want to watch how the economy evolves from here. The main bull thesis right now is the economy is strong. That's going to drive company earnings. That theory got tested a little bit today with the data that we got. It looks like Microsoft has beat on earnings. They are up close to about 5%. That was around the expected move. So maybe Tom Lee is correct yet again. Never mind. Microsoft up 5.5%. Google coming out with their earnings up over 12% after declaring a surprise dividend. Wow. Yeah. This could be a different story coming tomorrow. NASDAQ currently up 1.3%. Holy moly. Let me know what you think about this down below in the comment section. That's going to go ahead and do it for this video. You're not going to get much guidance out of Microsoft until the earnings call itself. So do keep that in mind. Still going to be a lot of volatility. But you guys have a great rest of your day, and I will see you in the next one.